In 2024, the artificial intelligence fintech industry was a $20 billion market that most investors overlooked as niche. By 2026, it is on track to become a $100 billion industry. By 2035, it will be a $1 trillion ecosystem. This explosive growth trajectory represents the single largest restructuring of financial services since the invention of the internet. Artificial intelligence is not just improving fintech, it is fundamentally rebuilding how financial services operate at every level, from consumer banking to institutional investment management to regulatory compliance. The global AI and fintech market size was valued at USD 15.4 billion in 2024 and is projected to reach from USD 17.93 billion in 25 to USD 60.63 billion by 2033, growing at a CAGR of 16.45% during the forecast period. But these numbers tell only part of the story. Looking forward, IMAR Group estimates the market to reach USD 97.70 billion by 2033, exhibiting a CAGR of 19.90% during 2025-2033. Different research firms project different growth rates, but every credible analysis shows the market expanding 5 to 7 times larger within the decade. The United States market is growing even faster than the global average. In the US, the market was valued at USD 10.96 billion in 2024 and is expected to hit USD 102.08 billion by 2032 at a 32.16% CAGR. This represents nearly 10 times growth in 8 years. Cloud-based solutions are projected to grow from USD 7.87 billion to USD 45.71 billion by 2035. The shift toward cloud-based AI solutions is fundamental to the industry's future. The investment tsunami reshaping capital allocation. The capital flowing into AI fintech is staggering in both scale and concentration. Fintech investments in H1 2025 totaled USD 24 billion across 2,597 deals, a 6% increase from H1 2024, with AI enablement driving surges in digital assets and payments. Fintech companies are leveraging AI technology to drive innovation in banking, risk management, customer service, and financial advice, which is attracting significant funding. Investments in fintech reached USD 24 billion globally in H1 2025, with AI native solutions attracting significant venture capital amid a focus on digital assets and efficiency. This represents a fundamental shift in how capital is allocated within fintech. Traditional fintech companies that do not have artificial intelligence at their core are struggling to raise capital. AI native fintech companies are raising billions. According to Menlo Ventures' recently published generative AI report, enterprise AI revenue reached $37 billion in 2025, up more than 3 times year over year, with $19 billion in user-facing products and $18 billion in AI infrastructure. This 3 times annual growth rate will not persist indefinitely, but even at more conservative growth rates, enterprise AI revenue could exceed $200 billion by 2030. From experimentation to operations, AI-specific funding is booming, with global AI investments reaching USD 200 billion, focusing on AI-native fintechs, with notable rounds including Tipalti's USD 200 million for AI finance automation and Alibaba's USD 53 billion commitment to AI products. The venture capital community has largely abandoned skepticism and embraced conviction about AI fintech's future. In Europe, UK startups raised USD 8 billion in H1 2025, led by AI and fintech unicorns. The geographic diversity of this investment indicates that AI fintech is not a Silicon Valley phenomenon anymore. It is a global transformation. X Insights reveal investor enthusiasm for AI agents in finance, projecting 20 to 30% efficiency gains by 2026. These projected efficiency gains are not theoretical. They represent actual operational improvements that fintech companies are already achieving. The geographic power shift Asia's acceleration. Asia Pacific is projected to register the fastest 33.1% CAGR through 2031, with China pouring USD 2.1 billion into generative AI in 2024 and recording 83% enterprise usage, dwarfing Western penetration rates. This geographic shift is profound. While North America pioneered AI fintech, Asia is adopting it at dramatically faster rates. The region's fintech revenue could move from USD 245 billion in 2021 to USD 1.5 trillion by 2030, with 87% of banks planning fintech partnerships. When you have 87% of banks planning fintech partnerships, you are looking at complete industry restructuring. Traditional banking and fintech companies will increasingly merge into hybrid entities. India and Japan extend momentum through inclusive credit and quantitative trading desks that rely on AI engines. The fintech revolution is enabling financial inclusion in developing economies by automating credit decisions and making banking accessible to populations previously excluded from traditional finance. Where real value concentrates, fraud and risk management retained 30.55% of 2025 revenues, confirming the segment's role as mission critical. Fraud detection remains the largest use case for AI in fintech because it directly impacts profitability and liability in 2025. It is estimated that AI-driven security solutions could reduce fraud losses by up to 40%. Chatbots and virtual assistants will, however, record the strongest 34.8% CAGR to 2031 as customers demand always-on support. Bank of America's Erica crossed 2 billion interactions by late 2024, proving that conversational AI boosts engagement. When a single chatbot handles 2 billion customer interactions annually, you understand the scale at which AI is transforming customer service. The global market for the use of AI for providing the help of customer service comes to USD 6.95 billion in 2024, has a CAGR of 20.4% from 2025 to 2033, and reaches USD 44.49 billion in 2033. Customer service represents one of the fastest growing segments because it directly impacts customer satisfaction and retention. Compliance as competitive advantage. An often overlooked segment is regulatory technology powered by AI. According to IMAR Group, the global regtech market, which leverages AI for regulatory compliance, was valued at USD 15.8 billion in 2024 and is projected to grow to USD 70.8 billion by 2033, exhibiting a CAGR of 18% from 2025 to 2033. Regtech is experiencing explosive growth because regulatory burden has become so complex that human compliance teams cannot scale. Regtech tools that parse new rules in real time and auto-update policy frameworks are gaining traction. This represents a fundamental shift in how financial institutions approach compliance. Rather than reactively responding to new regulations, AI systems automatically update policies and monitor compliance continuously. Mandatory data sharing rules such as PSD3 grant AI engines consistent, permissioned access to multi-institution bank records, enabling real-time credit scoring and hyper-personalized offers. When regulators mandate data sharing and require real-time compliance monitoring, they are essentially mandating AI adoption. Financial institutions that do not deploy AI will be unable to comply with regulations. Who is winning? North America held 37.60% revenue share in 2025, supported by a mature financial stack and clear though fragmented regulatory guidance. JP Morgan Chase fields 2,000 AI specialists and over 400 live use cases, underscoring local skill depth. The concentration of AI talent at major financial institutions is creating competitive advantages that are difficult for smaller competitors to overcome. Large enterprises retained 87.25% revenue share in 2025, reflecting deep budgets and in-house data science. This concentration of the market in large enterprises is concerning for fintech startups trying to build alternatives. However, regional players and niche specialists continue to find success by focusing on underserved segments. Credit scoring engines feed on alternative data to approve microloans within minutes. This represents a fundamental democratization of credit. Borrowers without traditional credit histories can now access lending through AI systems that evaluate alternative data sources. AI has the potential to significantly improve both the security of financial data and the effectiveness of financial processes. The trajectory is unmistakable. AI fintech will become $1 trillion industry within the decade. This growth will come from multiple sources, existing fintech companies adding AI capabilities, traditional financial institutions deploying AI extensively, new startups founded with AI as their core DNA, and emerging markets leapfrogging traditional infrastructure by adopting AI native solutions from the beginning. The companies winning this competition will not necessarily be the largest or the oldest. They will be the ones that most effectively combine cutting-edge AI capability with regulatory compliance, security, and customer trust. The fintech industry of 2035 will be unrecognizable compared to today, powered entirely by artificial intelligence, accessible to every person on Earth, and operating at speeds and scales that today seem impossible. The trillion-dollar fintech industry is not coming, it is being built right now, driven by artificial intelligence, funded by capital markets, and shaped by the founders and companies that understand this transformation.